We have now looked at output tax, the basics around that. Now we can look at input tax, which is a lot simpler once you understand how output tax works. Okay, so the most important thing that you have to remember is that input tax is not a calculation that you just perform. For exam purposes, yes, you're going to perform calculations because they can't give you a stack of invoices. But in reality, the input tax is claimed from a VAT invoice. The only exception to that is second-hand goods from a non-vendor. Right, so let me explain to you what this means again. This means, if you have a seller which is a vendor, and a buyer, right, which is also a vendor, the seller sells us something for 100 rands ex VAT, charges us 15 rands VAT, sells us 115. The seller will charge output VAT of 15 rands. The buyer will claim input tax. And how does that amount calculated? Now, in an exam, you're going to take this amount, and you're going to say 115 times 15 over 115. But guys, I want you to understand, that is just a calculation for you that you do to calculate the amount. In reality, you don't do that. In reality, you go and look at this invoice. And you say, what is that amount over there? Whatever that amount is over there, that is my input tax of 15 rands. So, if that amount over there is null because it's zero rated, then your input tax over here is null. If this is exempt, then this is exempt. If this is 1,000, then this is 1,000. So whatever this amount is over there, that is your input tax. So if they tell you in a question, this VAT vendor does not have a VAT invoice, then you can't claim. Very important. Right, so you can only claim this if you are going to make taxable supplies yourself. So for example, let me just explain again what that means, make sure everybody's on board. Let's say the seller is a vendor and you're a vendor. He sells you something, charge you 15 rand VAT, so 115 rands. But you, when you are buying it, even though you are a vendor, if you're not going to use it for taxable supplies, so let's say I buy a bed from a shop that sells a bed, and I'm going to put that bed in a residential accommodation. Residential accommodation is exempt, then I can't claim it. So even though I have an invoice, then I'm not using it to make taxable supplies, so I can't claim it. So you can only claim it if you're making taxable supplies. If you're making exempt supplies, you can't. So here's the definition of input tax in section 1. Can you see input tax, not input VAT? It says in relation to a vendor means the tax charged under section 7. Section 7 is the section we looked at, which is the output tax. That tells you when to calculate output tax. So it's the tax charged and payable in terms of that section by a supplier on the supply of goods or services to the vendor. Or if you import goods, then you can claim it. That is why when we looked at imports of goods, we see there's output tax and input tax, as you can see here. So what are they saying here? They're saying the input tax is the amount which is payable by the supplier. Now if I take you back, the seller is the supplier. The 15 rands, that output tax is payable by the supplier, and that is why you can claim that as input tax. That is what they try and tell us there. Right, so section 16.2 says, no deduction of input tax in respect of supply of goods or services, or the import of goods, or any other deduction shall be made unless you have a tax invoice. So can you see, guys? If you don't have an invoice, if you have no valid invoice, then you can't claim any input tax. So what happens on second-hand goods? Now, I want you to understand, sometimes students mess this section up, and you might even recall this a little bit yourself. Okay, now, if you are buying second-hand goods, if the seller is a vendor, they will sell it to you, they will charge you VAT, and you can claim the input tax of whatever that is, you can claim. Because there is VAT on the invoice. But what would happen in this situation? The seller is now not a vendor. So the seller charges you 100 rands, there's VAT of nothing, so 100. What is the input tax that you can claim? What does the invoice say? Nothing. So that means usually you can't claim anything. But now there's a special rule that says, if you buy second-hand goods from a non-vendor, I'm going to say, or if no output tax was charged for whatever reason, then the Act allows you to pretend that there was VAT on that amount, that 100 rands at the bottom there, the total price. They tell you, we will allow you to pretend. We will allow you to claim what is called a notional input tax. And what that means is, that 100 rands, you can treat it as if there was VAT on it, and you can then claim input tax. The reason for this, guys, is to help protect our second-hand goods industry in South Africa, because that is quite a big industry. So, if you purchase goods from a non-vendor, there can be no input tax because there's no VAT invoice. But make sure, the special rule says if you buy second-hand goods, make sure now as you see here, not new goods from a non-vendor, then you can claim the notional input tax. So here it is explained what is second-hand goods in section 1. Second-hand goods means goods which were previously owned and used. Right? Important, it must have been owned by someone else and it must have been used. So if I sell you something, I must have used it before. If I sell you a brand new item, yes, it's second-hand, it was owned by me first, but I haven't used it, so it's not second-hand goods. They tell you then it does not include the following: animals, goods which are gold and containing gold. Right, those are not considered second-hand goods, so you can't claim notional input tax. So, where do we find this rule? Section 1, the input tax definition, paragraph B. Guys, I'm going to refer to it quite often, so make sure that you know where to find this. This is where we find the rule that tells you that you can claim notional input tax on second-hand goods from a non-vendor. It says, in relation to a vendor, input tax means an amount equal to the tax fraction. The tax fraction is this 15 over 115. Right? The tax fraction, they say, of the lesser of any consideration in money given by the vendor, or the open market value of the supply of any second-hand goods situated in the Republic. Now guys, important, remember, each thing has a value rule and a timing rule. So the value rule says you must use the lower of the cost or the open market value. Remember, open market value, is the market value including VAT. Right? Then they tell you, provided that where it was concerned by the vendor wholly for such purpose or acquired partly for such purpose, then you can claim the VAT. So basically they're saying if you are making taxable supplies, for the making of taxable supplies, then you can claim it. Right, now that was the value rule. The timing rule, guys, this is also a section that you will see very often. You'll even see it when we're looking at fixed property. So what is the timing rule? This is found in section 16.3a. It's a bit more difficult to read, but understand what it says. It says, such as the provisions of subsection 2 of this section and the provisions of sections 15 and 17, the amount of tax payable in respect of a tax period shall be calculated by deducting from the sum of the amounts of output tax of the vendor which are attributable to that period as determined under subsection 4, and the amounts received by the vendor during that period by way of refunds. The following amounts, namely, in the case of a vendor who is, in terms of section 15, required to account for tax on the invoice basis, the input tax. So What they're saying is here, they're saying section 16.3 says, to calculate the VAT that you have to pay to SARS, you have to take the output tax, so this will all be all the transactions that you have, less the input tax. Now, it gives us a special rule here. It says, in respect of the supplies of goods and services not being supplies in terms to which paragraph B of the definition of section 1 applies. Right, so first up, input tax. Section 1, paragraph B talks about second-hand goods. So they're saying here, I'm going to make this comment, this means this does not apply to second-hand goods. So the first thing that they're saying here is they say, if you are buying things and you have a normal VAT invoice, like what we usually have here, where the person charges you 15%, it's a normal invoice, you can deduct that input tax. That is what they're saying here. Here's the special rule. This is the second-hand goods rule. It says, subject to the provisions of item BB, in respect of supplies of second-hand goods to which paragraph B of the definition of input tax applies. Right, so remember, paragraph B of the definition of input tax is what we looked at here. So they say, if this section applies, this is what you must do. They say you can claim the input VAT to the extent that payment of any consideration which has the effect of reducing or discharging any obligation relating to the purchase price has been made. Okay, so guys, what does this all say? This complicated section here. It says, if you are claiming buying second-hand goods from a non-vendor, you can claim notional input tax, but you can only claim it to the extent of payment. So in other words, can you remember when we started looking at this VAT, we said there's two accounting bases. The invoice basis, which says you pay it on the earlier of invoice or payment, and the payments basis, which says only claim VAT or pay VAT when it's paid. It says here, if you buy second-hand goods from a non-vendor, then you can only claim the notional input tax to the extent that payment has been made. In other words, only claim the input tax each time that you pay for the goods. So thus, do not claim at the earlier of invoice or payment. This is a special rule. So here's a summary of it, and you'll see it in the lecture example nicely explained. Second-hand goods. First thing is, if you buy it from a vendor, so the person you are buying it from is a vendor, they will charge you VAT. So it's a normal transaction. So the timing and the value, normal rules, normal rules. If you are purchasing it from a non-vendor, here's a special rule. The timing to the extent that payment has been made. So you can only claim the input tax each time you pay. And the value, you use the lower of the cost or the market value. A special ruling, guys, not as common to see. I'm just pointing it out to you. Do you remember when we had direct exports? We saw that it was zero rated. There's one special rule that says, if you had second-hand goods where you claimed notional input tax and you export it, it will not be zero rated. They tell you you will be treated then as if you had sold the goods for the original purchase price. So in other words, you will raise output tax equal to the notional input tax that was claimed. And you'll see this in your lecture example.